Okay, I think I'm mic'd up, so you guys should be able, and nobody's ever complained about not being able to hear me anyway. So, I do this quite a bit, and I get asked to be the speaker who comes to conferences like this and talk about the U.S. economy. It's not something that most economists are really comfortable doing. But I've been doing it quite a lot. I'm also somebody that's got experience in both the private sector and in academia. I have a master's degree from the London School of Economics, a Ph.D. from the University of Texas about 100 years ago. I went off into the academic world after that. Then I went into the private sector from there, and I've come back to academia now just teaching. So I still consult on the side. So that makes me a little bit more unusual than most academics. And so I kind of like doing these kinds of things. And that's why I get asked quite a bit, and I tend to stir things up a little bit. I'm going to warn you right now. So the topic of this is somewhat to present a forecast. And if you know anything about economic forecasts, they're worse than the weather forecasts. Okay, they are notoriously bad, and there's a very good reason for that. We're still talking about human behavior here. And human behavior has never been entirely predictable. And so sometimes economists, I think, portray themselves as somebody people who understand collective human behavior and are able to make forecasts based on it that turn out to be wildly inaccurate. So I'm not going to give specific forecasts. I'm not going to tell you where I think the stock market's going to be in 10 years or where interest rates are going to be, but I'm going to talk about broad themes that sort of get you to there on your own. Okay, and we'll be talking first about the economic miracle that wasn't. There's a lot of, and the intention of this is not to be partisan at all, but we're getting blasted with promotion now about how amazing the economy is. It's almost every day now, and I'm going to sort of put that to the test for you a little bit. We're going to talk about long-term prospects. I'm going to tell you right now, they're not particularly good. The current paradigm that we talk about in economics, and I'm not going to say that there's no dissent there is, but the current paradigm that is building, really, there's more and more research being done on this all the time, has actually got the horrible name of the secular stagnation hypothesis. Some of you may have heard of it. It is being talked about in the press. The Wall Street Journal will publish things sometimes, Financial Times. It's associated mostly with Larry Summers, who used to be the Secretary of the Treasury, very famous economist, will probably win the Nobel Prize someday. So we'll talk a little bit about that. We'll talk about the evidence for that. And then I'm going to throw a little bit out there to talk about short-term prospects as well. Now, I should also say that, like I said, I do this all the time, and I open it up. And I did this a couple of weeks ago in San Antonio to a group, and I think we got through 5 slides, in the session, in the hour-long session that we had, because people just wanted to talk about it. They asked questions. That's fine. I will do my best. If I don't know something about something, I'll admit that, I promise. But I can try to address those types of things. If there's something up here that goes beyond anything you're very interested in, and I'm not covering things that you want to focus on, that's fine. Give me a try, okay? So let's talk about the economic miracle that wasn't, and it's kind of a hard argument to make in a macroeconomy with an unemployment rate that's currently 3.5%. So you can see this is the unemployment rate going back to 1949 for the U.S. economy, and it fluctuates up and down. The gray bars are recessions. Okay, and so you can see unemployment goes up, right? During recessions, it comes back down during expansions, but it's never come back down to here, okay, except all the way back in the 1950s, and we touched on it a little bit in 1969. Unemployment got very low at the end of the dot-com boom in the 2000s here, but never down to 3.5%. So we're in somewhat uncharted territory here. And this is being promoted all the time as, oh my God, we've never had a labor market this good in our lives, right? These are the good times. We finally got there, right? And it's literally being broadcast to us on a daily basis these days if you're paying attention. So is that really true? Are we really in this euphoric economic climate? And I'm here to tell you that, well, there's some stuff going on that sort of makes that unemployment rate lower than it really should be. Okay, and let's talk about that a little bit. This is another closely watched metric on labor markets, the labor force participation rate. It is the fraction the percentage of the adult population, 16 and above, that's either working or actively seeking work. In order to be counted amongst the unemployed by the Bureau of Labor Statistics, we have a representative here, you have to be actively seeking work in the last 4 weeks, okay? And so the labor force participation rate is the fraction of the adult population that's either got a job or is actively sought one in the last 4 weeks. And you can see, going back to the 1950s, there's what we would consider a secular trend in increasing labor force participation due to women entering the labor force. Okay, men's labor force participation was actually declining somewhat over that period. So all of the increase is due to women's additions to labor force participation. Then it starts to level off because of mostly demographic trends. We get retirement of the baby boomers, right? You're getting more and more retirees relative to younger people. That causes the labor force participation rate to level off and probably decline a little bit, but then it falls off a cliff. Okay, it falls off a cliff, and it's down now to 63.3%, right, which is much lower than the 67 or 66 or whatever. And I've drawn this line back here to sort of show you how far back we have to go before we see a number like that. Okay, and this alone, decline in labor force participation on its own, will cause the unemployment rate to go down because people have quit actively seeking work. They're no longer considered unemployed. They're out of the labor force completely, not even looking for work anymore. That's what that drop represents. And that means that those people are not being counted as unemployed anymore, which makes the unemployment rate, and I'm going to use a term I don't necessarily like, artificially low. It's not artificial. It's just not comparable. We're not comparing apples to apples, comparing our unemployment rate at 3.5% now to what was going on in the past. So let's look at a little exercise here just to bring this home. And this exercise is a little extreme to bring the point home. But if I relax the assumptions a little to make it less extreme, it's not going to change the overall outcome. So look what was going on. Adult population right now, these are all in thousands. Okay, these are the most recent numbers from the BLS, 260 million adult population. Okay, participation rate, 63.2%. Labor force, employed plus unemployed, meaning actively seeking work, 164 million. 158.8 million employed. The unemployed are 5.7 million, the unemployment rate at 3.5%. You can do the math and it comes out to 3.5%. Okay, well, let's go back and pull out a labor force participation rate consistent with different economic times in the past. What if the labor force participation rate was consistent with its higher levels from before? I've pulled 67.3%, and honestly, I can't remember what year I got that from, but it's going to be from around it's going to be from before the Great Recession, when we saw it fall off a cliff. Okay, so if I were to say, what if we had the same labor force participation rate we used to have? What if all those people hadn't dropped out of the labor force? Okay, well, then we can do the calculation on our own. You follow through to the bottom, our unemployment rate would be 9.3%. Okay, so all I'm doing here is creating a counterfactual argument that's saying if we had as many people seeking work as we used to have in the labor force, right, and they're not anymore, they've dropped out, which means they don't count, our unemployment rate, if we were counting those, the unemployment rate would be much higher. Okay, and so there's a certain artificiality then to that low unemployment rate. Things have changed in a way that make the unemployment rate go down without the labor market necessarily improving very much. And that's not necessarily good news. Okay, people who are not participating in the labor force are not really earning much of an income, quite obviously. Yeah, go ahead.
Do you have a reason for why they're not?
Well, that's a really good question. There has been quite a bit of work done on this, but it's not all definitive. There's quite a bit. We've got some of the more interesting research that's been done by academics is a little alarming because there's actually evidence from academics that things like opioids, I don't know if you remember the great Alan Kruger who committed suicide. I don't know why you would, but he's a very famous labor economist. Again, was going to win the Nobel Prize someday, almost assuredly. He committed suicide tragically just a couple of years ago. Nobody had any clue. But he was brilliant, and he wrote all kinds of interesting stuff. And one of the things that he and a co-author did is they got data where they were able to match up opioid use with, I believe, county-level labor force participation, and they were able to show a very strong correlation between opioid use and low labor force participation. And that doesn't prove causality, but they also did some causality testing that sort of said that they believe that that was really where the causality was. That's tragic, right? And I got to tell you, it's not something that the rest of the world really necessarily understands, because I do these types of talks to groups from Europe-wide. There's a group of executives that come through the business school every year, and then a group from Finland. And I started talking about this exact same point to them at one point, and they had to stop me, and they're like, what are you talking about? What is this opioid crisis you're talking about? And the people don't necessarily know. It's a very much an American phenomenon. There's also been some quite startling research that talks about labor force participation of young males being lower because they're staying home playing video games, which, again, is tragic. Now, again, is that causality? Are they just staying home playing video games because they don't have any other opportunities, or is that causing them not to go to work? But the correlation in the data is there. Now, that's probably somewhat trivial, right? But there's all kinds of other things going on in the economy right now with respect to the labor force, the growth of the gig economy. So maybe some of these people who are dropping out of the labor force are people who are, well, I didn't really want to work that much anyway. I'll go back and drive for Uber for a month, right? And then make a little money, and then maybe I'll go take a class or something like that. We don't know exactly. It's getting more and more refined, the data. But in order to understand absolutely every reason why people were doing this, we would have to be able to survey people in very specific ways, okay? But I imagine the gig economy has a lot to do with this, the way the structure of work has changed in the United States because of the gig economy, okay? And so, but beyond that, I can't give you many better answers. Those are some candidates. There's also a lot more people retiring early. If I was the age I am now when the Great Recession hit, I would have probably said, and I got laid off, I'd have probably said, what the heck, I might as well just retire. I'm getting close anyway, right? And so there's probably quite a bit of that going on too. There are more early retirements, we do know that. Okay, so, yeah, go ahead.
Do you happen to know if the upcoming census is going to ask this question?
No, these are not census typically questions. These are from the Consumer Expenditure Survey, the current population survey. Vince is probably going to be a better reference on exactly the details of all of that. This is all done by the Bureau of Labor Statistics, okay? And they survey households every single month. How many? 50,000, something along those lines?
That sounds
right.
It's the Census Bureau that actually...
They do it in conjunction with census, I know. And then they follow the same households for a period of time, and then those people drop out, and they rotate new households in, things like that. So it's done every single month. It's a massive and extremely impressive piece of statistical work that they've been doing for decades now. But they do redesign the survey every now and then so that they ask different questions. But getting at every new reason why people are behaving differently than they were historically is going to be a very tough answer to get. So which one were you particularly interested in? Anything in particular in the census? Just the labor force participation rate, yeah. So, but labor force participation rate being low means that those people aren't essentially participating in the economy, at least not in the official economy. Okay, yeah, go ahead.
You kind of mentioned this, it's kind of quantified, but is there any estimate for if that labor force rose back up, what percentage of those people would they 100% not be able to find work, and so it's 9.3, or would some percentage of them?
That's a we don't know exactly, but we've got historical data showing those flows. Like if you can look up how many people every single month, or you can at least derive it, how many people were in the labor force and then went to becoming unemployed. So they were now actively seeking work, or they took a job and they went straight into employment. All of that is there, and you can sort of piece that stuff together, but I don't know exactly what it's going to tell us right now. I'm not sure I can answer that question. Okay, but so here's another piece of interesting news, mostly based on economic, the economic policy making more than anything else, I suppose. The Congressional Budget Office publishes the most reliable, probably, and certainly the most used estimate of what we call potential GDP, potential gross domestic product. And you probably know that real gross domestic product, real GDP, is how we measure progress in our economy. Right? That's essentially the value of everything we're producing in the economy and consuming as well. Okay, and so these are the CBO's estimates every year. Now, why does the CBO need this? Well, because the CBO has a big model where they assess tax changes, spending changes, so that they can understand the influence of fiscal policy on the economy. Okay, so every time a new budget comes out and they talk about a budget is submitted, it has to be scored so that we understand what the implications of the budget are for government debt and for the economy, et cetera, right? That's all coming from the CBO. So they've got a big model and they release all their results. A government agency, they got to be transparent. They release everything to us so we can tell what their model is saying and what assumptions that they're building in. Okay, and this is the CBO's estimate in 2007 of potential GDP. If we're using all of our resources efficiently, not overusing them, but using them efficiently, then that's what GDP should be. So this is a measure, it's kind of a target, right? If you know that you're doing okay if you've hit potential GDP. If you're below it, you're probably in a recession, right? Or maybe not an official recession, but you may be close to it. Okay, so this is what essentially where they think the economy is going to be. So this is their estimate and their forecast as of 2007. Okay, and then the Great Recession hits. Okay, and the Great Recession, you can see this is actual GDP. Now the scale, I got to probably say something about this. The scale is not actual GDP. This is actually from, I think, one of Summers' papers. They've actually made the axis so that this becomes more obvious, right? If we were to just use GDP, it wouldn't be quite as obvious, so it magnifies things. But it doesn't take what's going on away at all. So here's what actually happened. We get a massive recession, the second worst recession we've had since the Great Depression in this country, right? And people in Texas sometimes don't understand. I know you're not all from Texas, but Texas, skated through this pretty well. Right? We had our financial crisis back in the late 1980s, okay? And we didn't do nearly as badly as other parts of the country here, and people sometimes don't understand how bad this was, okay? And so massive decline in GDP, okay? And then you can see it kind of skates along here. And, when you go into a recession like that and you see something like that happen, right? What we teach our classes is, and especially if they're lower level classes, is, well, now it's time for the government to do something. Okay, it's time for the government to step in and design policy. We did get some of that, right? We got the American Recovery and Reinvestment Act, the Obama stimulus. We got monetary policy. Unfortunately, if you know anything about the theory of monetary policy, this is the time we're in a situation here where monetary policy is going to be at its least effective. We needed more fiscal policy action to right the ship and get us back on the trajectory. And that's pretty much a consensus nowadays amongst monetary policymakers globally. They are crying out for legislatures and parliaments and governments to step up and do something and spend more money and get us back on the right trajectory. Then once we're on that trajectory, we can worry about getting rid of that spending then. Okay, and so instead of saying, okay, let's see what policies we need to implement to get us back where we thought we were going to be, the government essentially, we talked about Super Bowl before, we got football terminology now, they punted. They said, well, I think the productive capacity of the economy was actually lower than we thought it was. So in 2009 now, they're going every other year with the forecast in this diagram. Look at where the potential GDP forecast was. No, we weren't going to be up here. We had that wrong, right? Really, if we were using all of our resources efficiently, we should have been here, okay? And then we still don't get anywhere near it, right? We don't get the policies we need to get anywhere near it. And so 2 years later, they just revise it down again, right? This is where we should be. And they just keep doing that until now, hey, look, we're back on the right long-term trajectory again. But that long-term trajectory is dramatically lower than what we thought it would be before the recession. Did the recession really wipe out that much of our productive capacity so that we can't possibly ever get back on the trajectory we were before? We just revise it down? There's a lot of economists who have a problem with that, and they think that government policy was inadequate in order to get us there. Okay? So I don't want to just focus on this stuff. this is my, again, not trying to be partisan, okay, but are we experiencing an economic miracle as we keep getting tweeted about? I think it happened again today or yesterday. Last 12 quarters of the Obama administration, average rate of growth of GDP, 2.6%. First 12 quarters of the Trump economic miracle, average growth rate 2.9%, and it's come down since then. So we're pretty much a level playing field now. Okay, and you can see, I mean, the economy was cycling, and it's continuing to cycle. Okay, monthly change in employment, right? These are the jobs numbers that come out monthly, right? Additions to employment. Last 26 months of the Obama administration, average monthly job growth, 224,000. First 26 months of the Trump economic miracle, average monthly job growth, 189,000. We're not improving. Things have not gotten better, despite the rhetoric that we're hearing. Okay? This doesn't go all the way to current times, but I think the last jobs report was, what, 115,000 for the month? So it's come down since then. This has gotten so busy, I add to this every time I give a talk. I need to turn it into quarters, and I didn't have enough data to do that yet. So you're not getting all the most recent data, but it has come down in more recent months. Okay, so let's talk a little bit about this secular stagnation hypothesis, because it really has implications for the industries that you represent. Okay, I think a lot of this is based on insufficient capital investment, okay, as we're going to see. So I don't even want to do this slide. This is, you want to take a look at this later. I'll talk about this one, and we'll go straight to the schematic that I've put together to explain this. Okay, so these are the things at the heart of secular stagnation, which means we're in a situation right now where we think the economy is going to perform at a lower level into the indefinite future. Okay, we'll talk about what the implications of that is in a second, but just to whet your appetite, that's essentially what the hypothesis says. We're in a situation right now where, because of natural things going on in the economy, some natural and some things that we could do something about, okay, that we're not going to we can't really expect to perform at the same level that we did previously. Okay, this is not just us. And one of the messages I'm intending to convey here before this gets too dismal, I mean, economics is frequently called the dismal science. It's not my intention to spread that. Okay, but if you want the positive news, it's as bad as things may be here, and they don't look that bad, I understand that, but we're not in a boom at all on a nationwide level. Only if you're in Austin, right? This is a boom town, but you go outside of Austin, you don't necessarily see what's going on here. Okay, but it's worse in other parts of the world, right? We are still the engine of opportunity for the global economy, right? And we're not performing up to the standard that we probably could, but we're doing better than most of the rest of the world, okay? And that's why, that's some cause for optimism. And if nothing else, it means that the rest of the world is going to continue to essentially finance our economy, because the rest of the world is uncertain. They have very limited opportunities, right? And when that happens, everybody brings their money to the United States, okay? And that's what's been going on since the Great Recession, the search for yield, okay? Where is it coming from? Well, demographic transitions. Let me just preface this a little bit. I probably should have before I put this slide up. The fundamental problem that Larry Summers and other secular stagnationists, to coin a new school of thought, what they say is, what's holding our economy back is insufficient spending, aggregate demand, as we call it in macroeconomics, or AD, right? Insufficient spending. There's not enough spending going on by households and firms, and by implication, governments as well, when you need them to step in and fill that gap. Okay, why is there not enough spending? Well, because there's certain things going on globally that are causing sort of the hoarding of the available funds among certain segments. Okay, one of them is demographics. The world is getting older. Okay, I mean, look around, right? I mean, we are aging. It is not nearly as much of a problem in the United States as it is in other countries of the world. There's been quite a bit written just in, say, the New York Times in the last couple of weeks about the Chinese demographic crisis, right? They're in way worse shape than we are. Okay, we got lots of old people and not very many young people. what do the old people do? They save, right? That's not what you need. I don't want to, no economist is going to get up here and say, nobody should ever save. That's bad for the economy. For the long run, you need savings, no doubt. But in the short run, when you're not performing up to the standard that you should be, for example, when you're in a recession or when you're suffering in sort of a low-level malaise like we and the other parts of the global economy are right now, right? Then you need that. You need spending to get you out. Once you get back on trajectory, then you worry about the long term, okay? So the demographic transition is going on globally, not just in the United States, and it means we got a lot more people saving and a lot fewer people spending. And that, generally speaking, is bad for your economy. Japan was the first one to go through it. We're now talking about Japanification of other Western economies like the United States. Like I said, China has got the biggest problem of all. They suppressed their population growth for so long that their population is aging much more rapidly than ours is. Okay? That's one source. Increasing inequality is another. Right? There's no doubt that when you look at the data, right, that inequality has increased globally in many aspects. Okay? There are some fabulously wealthy people out there. You've heard the alarming statistics, I'm sure. They don't spend that money. Right? Well, let's put it this way. You give Bill Gates a tax cut, does he say, I can finally go out and buy that motorcycle I wanted? No. He just puts it where all the rest of his money is. Okay? He parks it. Okay? Whereas you give a tax cut to a lower income person, they're going to spend the money. They're constrained. They're what we would call liquidity constrained. They don't have the funds they need to buy everything they want. So if you give them more, they'll spend it and stimulate the economy. We, in this country, keep targeting our tax cuts at the wrong place, and we just did it again with the last one. Okay? So increasing inequality is a force behind this. The wealthy people of the world have hoarded funds. They want to park that somewhere safe. It's not just people, it's institutions too. We're going to talk about that. They don't necessarily, if you're Bill Gates, right, you're obviously using your money to fund charity. You might got some venture operations, but in general, you want to park your money safe, right? And I don't want to, Bill Gates is a stupid example. But if you're a wealthy person overseas, right, you want to park your money somewhere where you can earn a decent yield. Well, let's say you're in Europe somewhere. You're in Luxembourg. You go to Germany and buy boons, you're going to earn a negative yield. So where do you go? To the United States. You can earn a positive yield. All these funds are flowing into the United States, which is keeping our interest rates low too. But it's a reflection of the problems that I'm talking about. So increasing inequality is an issue. Surplus countries. I'm going to show you some data on this in a minute, and I'll throw out an open-ended question for that. Certain countries of the world have run up massive current account deficits with the rest of the world. Okay, current account deficits essentially the same thing as a trade balance. Okay, so some countries of the world have exported massively. In other words, they've restricted consumption at home of their own citizens in order to emphasize selling to other countries. They have generated massive current account surpluses. Those are funds that have to go somewhere, right? They're sitting in foreign reserves or other types of things like that. They got the same thing. There's all this money that they don't want to put it into something risky. They want to park it. They're going to search for yield. So the world is awash with all these funds. And I haven't even put up here reducing spending overall. The global economy is spending less because of these forces. Okay, so what does that do? Well, that leads to low productivity and low return on capital investment. Why? There's a link there that I might want to, well, it's actually over here, so let's put it over there. Reduced capital investment. Okay? And maybe I should have put that arrow first then. I'm starting to rethink my slides now that I'm up here. But when people aren't spending as much money, when customers aren't spending as much money, then you as firms don't have as much incentive to engage in capital investment. If you're not engaging in new capital investment, the new technologies that are embodied in that capital investment are not being made available to the world, and it's not enhancing our productivity at all. In order to keep an economy growing, we need productivity, output per worker, to be sufficiently high. But if nobody's spending money on stuff, then the companies are not going to invest in new plant and equipment that's going to generate those new technologies for the rest of the population. Okay, that's one of the basic premises of secular stagnation. Okay, and it's kind of hard to disprove that as well. Okay, so reduced capital investment, again, the new technologies are not coming out. I mean, I heard somebody earlier today talking about how as we roll out this new stuff, all those new technologies replace all the old stuff. That's what we're talking about here, is not enough of that has been going on. Okay, not just in your industry, but globally in all industries. Low productivity and low return on capital investment. I mean, if I'm getting a low return on my capital investment, then I'm not going to invest as much, right? And that's going to contribute to the problem. And so we kind of get a vicious circle going of declining global demand. Households are spending less, firms are spending less, nobody's going to step up and fill the gap, then we're going to be stuck in this malaise indefinitely, is the basic premise of the theory. Okay? So this is just for facts purposes. I should have thrown, actually, I've just given it away. I was going to give you guys a question. Who's got the biggest current account surplus in the world, biggest trade surplus with the rest of the world? Everybody always says China. It's wrong. China does with us, okay, but not with the rest of the world. It's Germany, Japan, Russia, okay, Netherlands. You don't get to China till you get down here to 10th place, I think. Okay? So the general perception that people have that it's all China's trade surplus that's causing the disruptions in the global economy is not true at all, right? This country right here is frequently blamed, and this current account surplus is blamed as being one of the primary causes of the European crisis in the southern part of that country that almost got those countries kicked out of the EU because Germany wasn't happy about bailing them out, okay? They turned around and said, yeah, but if you just ramp up your own consumption inside Germany and stop exporting everything to us, then this would go a lot smoother, and it would. Okay, so there's a lot going on here that needs to change before we're really going to get out of this type of malaise. So what's the evidence? Okay, I've given you the hypothesis. What's the evidence? Well, here are the implications. Low productivity, low return on capital investment, slow economic growth, low inflation, and low expected inflation. I mean, you know, I grew up in the 70s. I get in front of my classes now and I tell them inflation is too low, and it's so hard for me to get those words out, right? Because we never thought of too low inflation ever being a problem. Well, it is. It's a big problem now. Okay, and I'm going to show you some data that says the markets are predicting inflation to be crazy low by historical standards into the indefinite future. That's bad news. That's a reflection of secular stagnation. That's why it's on this list, right? If people were spending more, prices would increase faster, right? That's what we need, is for inflation to go up as a reflection of increased spending. Okay, we don't want it to go too high. I'm not claiming that. Okay, but we need it to go up. I mean, we flirted with deflation during the Great Recession, and other countries have actually experienced it. It's pretty much the worst thing that you can ever have happen to your economy. Okay, we've only experienced one bout of sustained deflation in the United States economy in history, and that was the Great Depression. Okay, I don't want to go back there. All right, so continued low interest rates, another implication. Okay, so let's look at this. This is what we call the productivity slowdown. Okay, it's well known in economics. Output per worker hour is how we measure productivity. Okay, not just output per worker, but some workers only work part-time, some work full-time, so you divide by worker hours. Okay, so it's real GDP divided by total hours worked in the economy. Look at how it's fallen from the 1990s to the 2000s to the available data in the 2010s when I drew this graph. Okay, this is terrible news. There's only two ways to get your economy to grow. Increase the labor force and increase productivity. Okay, when labor force isn't increasing, labor force participation fell. Okay, and productivity has fallen as well. So this is bad news. And before I came here, it's not in this deck, and I wish I'd gotten in here now. I actually did a little research on your industry, which I am certainly not an expert on, for which I apologize. If I'm talking to your group, I should probably know more about your industry, but I don't, and so I decided to do a little bit of research, and I looked up, and you can actually get a BLS working paper that talks about capital investment in different the different industries that are and beyond that represented in this room. So and it reflects this. There was only one industry, and I think it was wireless equipment manufacturing, where productivity had gone up. Okay, since 2010. It was 2010 to 2017, I think, in the report I read. All the other ones, productivity had come down, and dramatically in some cases. So this is affecting your industries as well. Okay, productivity's way down. All right, here's the reflection of that, return on investments. Okay, so this is actually stolen from one of Larry Summers' papers. All right, this is showing you the real yield on different types of assets. Yes, we've got low interest rates, but so what? Low interest rates can mean, great. We obviously have valuation experts in the room. Low interest rates can be great for valuations, right? But we're seeing all asset classes decline. Real means that the effects of inflation have been taken into account here, right? It's the nominal yield minus the rate of inflation. Think of it that way. Okay, and you can see that over time, whether it's the S&P yield, the real AAA corporate bond yield, the real BAA, or the 10-year Treasury yield, they've all come down. Okay, that's a reflection of secular stagnation. I keep turning on CNBC and hearing all this stuff about how amazing the market's been. Right? We were up 28% last year. I can't tell you how many times I heard people say that. We were up 28% because we fell 20% at the end of the previous year. Right? We were barely up over the year because the stock market fell dramatically right after Christmas in 2018. Remember that? And then we pick up from there, and it's like, yeah, sure, because it recovered, and now it's up 28% for the year, right? It's just nonsense, okay? So, and you can see that right there. Here is one of Larry Summers' favorite stories. He doesn't draw, this is my graph, not his. Okay, one of the implications of secular stagnation is that over the past few decades, okay, the growth rate, the lower growth rates that we've been able to achieve, and they have been lower than they were historically, even those are being artificially propped up, right? Because we're in a world now where growth rates are going to get lower until we do something to fix that, right? And so what we're doing is not fixing it. We're engaging in a series of these policy actions that are intended to bump that number up, but they can't be sustained into the indefinite future. So even when we are in an expansion now, it's being driven by something that we can't sustain into the indefinite future. Okay, so here are the potential candidates, right? Growth, real GDP growth was high in the 1980s, okay, but that was also the massive increase in the government budget deficit. Government spending went through the roof in the 1980s, and the Reagan administration and Congress cut taxes at the same time. That's going to stimulate spending in the economy. That's the kind of stuff policymakers are clamoring for now, monetary policymakers, okay? And we got that in the 80s. In the 90s, we had the dot-com bubble, okay? There was a lot of deregulation going on through that entire period, right? But you can't deregulate forever, right? Eventually, you got no regulations left to deregulate, right? And then the economy can't continue to perform at that same level, so it drops again, right? And then we bump it up. We got a housing bubble that sort of bumps it up again artificially, but that can't be sustained indefinitely, as we saw, so it comes back down again, and boy, did it. Then we got a quantitative easing bubble, perhaps, right? And then a tax cut bubble over here. It wasn't a very sensible tax cut intended to increase spending in the economy, so it's not the type that we need in order to get out of this problem. So these are the different things that have been implemented or that have occurred, right? They're not all government policies, but they're all implications of government policies, okay, that have basically kept our economy afloat, and we just keep trying one thing after another, right? Well, we're running out of ideas, right? I mean, what's the next big idea that we're hearing about right now? About, well, if the economy continues to everybody thinks it's slowing. If it continues to slow, what are we going to do about it? And all we're hearing about is more quantitative easing, right? Going back to the Fed buying up assets, okay? It's not going to have a whole lot of effect. We know that, but we don't have nothing else to do, right? We got to do something that's going to have some marginal effect at least, Okay, so that's what we're hearing. The Fed may start up again. We don't know. All right, now things get a little bit theoretical, and I hesitate to do this. This is the Phillips curve, okay? And it's the same Phillips curve I showed in my classes, and I apologize right now for doing that to you. But one of the implications of secular stagnation is the lack of inflation in the economy, and it's become so pernicious now that we got a name for it. It's called the missing inflation puzzle. And before we had that, we had the missing deflation puzzle in the Great Recession. Right? All of our models, all of our existing economic models, not all of them, but most of them, said that given the state of the economy during the Great Recession, we should have actually seen deflation. Their models were predicting negative inflation rates, and we didn't get there. Okay? And now our models are saying inflation should be higher than it is, and we're not seeing it. Okay? So here's the Phillips curve. The Phillips curve is a very well-known relationship between the unemployment rate and the inflation rate. So this is the unemployment rate right here, okay? And this is the inflation rate. Pi is just the term we always use for inflation in macroeconomics, okay? So what this says is, and the Phillips curve tells you essentially that there's a negative relationship between those two things. Why? Well, think about it this way. This is a simplified explanation, but it's not wrong, right? And when unemployment is very high, okay, there's lots of surplus labor out there. If firms want to hire somebody, all they need to do is offer a job. They don't have to raise wages to do that, and therefore prices don't have to go up. Once you get back down to this is labeled as U star, that's what we call the NAIRU. Okay, I mean, I heard a lot of acronyms in the earlier presentation, so you get one now too. But it's a terrible one. Economists are horrible at acronyms. Non-accelerating inflation rate of unemployment. I don't know who came up with that. Actually, I do, but we'll skip that. And so what it says is if your unemployment rate gets down to this critical point, okay, meaning everybody who wants a job essentially has one. You're at full employment there. Okay, doesn't mean unemployment is zero. There's always going to be positive unemployment even when you're at full employment. People looking for jobs. Okay, so what it says is if unemployment gets down so low that now as the economy continues to expand, if firms need workers, what do they have to do? They got to raise wages, right? Because there are no available workers out there. Or maybe there are some, they just haven't responded yet, so now I raise wage, they come in out of the labor force, or I attract them from another firm. So when the unemployment rate goes low, historically, we see higher wage inflation and higher price inflation. And it's been pretty much a programmed response over the years. Okay? And that's why all of our fundamental economic models have been based on the Phillips curve. Right? And unemployment gets low, inflation goes up time after time after time until now. Okay? And for the last 10 years, maybe a little bit more, it doesn't work. The theory is not working anymore. This is the dominant paradigm in macroeconomics, and it's not working. So research is underway right now to try to explain this, build a better model. This graph is from The Economist magazine. What it's showing you is that the negative slope, I mean, it doesn't look anything like the Phillips curve I drew because that's just meant for illustration purposes to get the idea across. This is the Phillips curve using data from 75 to 84, relatively steep. It started to flatten. Now it's basically gone. It's just a flat line. This is the missing inflation puzzle. Inflation is low, as you can see, right? Even though unemployment is very low, okay? And that can only be explained, so far as we know, by this secular stagnation hypothesis, right? The unemployment rate being low is artificial, as we said. Okay, there's all these people that are not in the labor force that historically would have been exerting pressure on wages then, and they're not. So we're not getting inflation. The unemployment rate, everybody said, we need more inflation. That's great. As the unemployment rate comes down, the inflation rate's going to go back up. We're going to be out of this problem, right? And then it didn't happen, and it continues to not happen, and it's been going on for years now. And we don't necessarily understand all of that, but it's the pet hypothesis is this is a reflection of secular stagnation, everything that I'm talking about right now. Okay, so this is the missing inflation puzzle that I was talking about before. It continues to be a problem, and it will continue to be a problem. Why do I know that? Because we have measures of expected inflation. This is the market's expectation of the average inflation rate expected to prevail over the next 10 years. Doesn't say what it's going to be next year and the year after that, the year after that, the year after that. We can't get that from the data that we've got. But what we can do by comparing the yields on Treasury inflation protected securities, TIPS, with actual Treasuries, we can say this is the market's anticipation of what the inflation rate will be on average over the next 10 years. Okay? As of the date I took this data, which is just a couple of weeks ago, maybe even less than that, what markets were predicting was over the next 10 years, the inflation rate was going to average 1.7.2%. That's measured by the CPI. The Fed targets a 2% inflation rate, and they can't hit it. But they don't even target the CPI. They target a different index called the PCE Core. It's the Personal Consumption Expenditures Index. They eliminate energy and food commodities from it. It has a tendency to be even lower than the CPI. So the Fed has set a 2% target for its preferred inflation rate. If 1.72 is the CPI inflation rate, then the PCE inflation rate that's expected is going to be about 1.22%. Okay? In other words, market participants have no confidence that the Fed is going to be able to hit their inflation target. They said they're going to conduct monetary policy in a way to hit that target. They did that in 2012. I think they've hit it maybe 3 months out of all that time. They're starting to lose credibility, which is why they did, I don't know if you remember at the turn of the year, they did a complete flip-flop and said that's what we're going to start emphasizing now. They basically admitted, yep, we haven't hit our inflation target. Yep, that's starting to affect our credibility. We covered our credibility strongly as a central bank, so now we're going to go after the inflation target aggressively. We're still not there. Still not getting anywhere close. Okay, that's bad news for the future. Again, it's very tough to be telling an audience for somebody who grew up in the 70s that low inflation in the future is bad news. But it is, because it's a sign of reduced economic activity. Okay? How about lower interest rates? This is the 10-year Treasury yield. There are thousands of interest rates out there. Got to pick one. Right? This has got consistent data going back to into the 1950s. It's the 10-year Treasury, which is the most liquid financial instrument in the world, I believe. Okay? So you can see that from the 1950s all the way up to the early 80s, some of you are old enough to remember Paul Volcker as central bank chairman, I'm sure. Okay? The 10-year Treasury yield just increased steadily, a secular trend upwards. Right? From then on, it started coming back down, From the day we got to about, I don't know, here, somewhere around there, you started hearing people say, okay, I can see this thing goes up and it's got this long wave cycle. Right? It's come back down, and now it's going to start to go back up. And you can see this little upturn right here. Everybody said, here we go. It's going to go back up again. And it hasn't. We've been at 7, 8 years now. We've been at or near record lows for the 10-year bond yield. Again, reflecting perceptions of low economic performance into the future. I'm going to show you something a little bit about that too. So we don't think it's going up. We can get market expectations of where we think the 10-year bond yield will be too, and market participants don't think it's going to be much higher than it is today into the 5, 10-year future. Okay, so what are the determinants? What's changed? Okay, what are the determinants of the 10-year yield? Well, the nominal yield is the published yield. Okay, that's the yield that's on the bond. It's published at the bank, on the marquee. It's on your credit card statement, whatever. Okay, we're doing the 10-year Treasury yield here, so it's the number in the paper. Okay, well, that's got underlying it, there's a real yield, the fundamental underlying yield for a 10-year bond. Okay, stripped of inflation, basically. So that's approximately, economists have historically focused on a number of 2% for the real interest rate. You can't necessarily get a good number. I mean, you can get estimates of that, don't get me wrong, and we can get market-based estimates. But we're still not exactly sure what is the real interest rate. But economists just plugged in 2% for decades, okay, because they thought it's right around 2%. All right, so we'll go with that. From the 1990s, we're going to just pick another era, okay, when interest rates were higher. Then, if you know anything about bond yields, you know that they respond to inflation. The Fisher effect, it's called, named after a famous economist named Irving Fisher. If we think inflation's going to be higher in the future, interest rates go up to compensate people for the higher inflation. I don't want to get paid back 5% if the inflation rate's going to be 10%. Okay, that makes no sense at all. So bond yields increase with inflation, and in the 1990s, 3% is not a bad guess for what the expected inflation rate was going to be. Okay, then on top of that, I'm assuming we have experts in the room, but I have no idea what's going on. No, my animation stopped. It might. Is this battery? Maybe the battery's dead. Well, that works. Okay, I'll use the keyboard. Okay. What is that? Okay, all right. I'll try to pull that off. So then on top of that, remember, this is the 10-year yield. Okay, the term premium is essentially the additional yield you get over short-term bonds. Okay, short-term bonds typically pay lower yields. Why? Well, the 10-year yield, according to financial theory, should essentially be the average of all the short-term yields that prevail over that same horizon. I can either buy a 10-year bond, or I can buy a series of one-year bonds and roll them over every year for 10 years. Okay? Financial theory says those things, except for this term premium, those things should be equal. Okay? But the term premium is the additional amount for what we call interest rate risk. So if interest rates are expected to change, those short-term interest rates start to fluctuate up and down, okay, then the 10-year bond yield is going to be higher, okay, to compensate for that additional interest rate risk. Okay, so that leads up to about 7%, which is fairly accurate for, up to about the mid-1990s. So what's different in 2020 that's got our bond yield so low? Well, first of all, current estimates for the real yield are really low. 0.5%, the economy is not performing. This is basically a rate of return. And remember, we saw that graph that showed all the rates of return in decline. Okay, here's one of them right here. Okay, so real interest rates have fallen because of the decline in economic activity. Then expected inflation has fallen. I gave it generous at 1.5%. I just told you it's probably more like 1.2 right now. Okay, and then there's no term premium at all. Okay, because market participants do not perceive that those low interest rates are going to change. Remember, this part is the compensation for the additional risk of holding a 10-year bond. I could have held a series of one-year bonds and eliminated the risk that interest rates were going to change. If interest rates change against me, I quit after 5 years. Okay, whereas if I'm holding a 10-year bond to maturity, I don't have that luxury. I'm stuck with it. At least somebody is. Okay, I should say the bond is stuck with it, not the investor. The investor can sell it. Okay, so the term premium is gone, a reflection of secular stagnation. Expected inflation is lower, a reflection of secular stagnation. And the real interest rate is lower, a reflection of secular stagnation. It's hitting us at all corners, and it's affecting everything in the economy. Okay, so I don't know why I'm holding this anymore. Okay, so the yield curve, as you probably know, describes what we call the term structure of interest rates. Okay, the difference in yields between short-term bonds and long-term bonds. These are all treasuries. We could do this with corporate bonds of the same rating as well. Okay, but it's a very well-known curve, the Treasury yield curve. It's very flat at the moment up until about the 7-year point, and then 10-year is up here. Right? Normally, the yield curve is more upward sloping than this. Historically, it's steeper. Right? Normally, an inverted yield curve is a signal of a recession. Okay? So, and you may have been cognizant of this when it was going on over the last year or so, we have had yield curve inversions recently, which is, again, more kind of dismal news for the future because the next graph will illustrate why. One way that we summarize the slope of the yield curve, remember it went everywhere from 30 days, 90 days, 1 year, 2 years, 3 years, 5 years, 7 years, all the way out to 30, okay? But one way we summarize it is just by taking the difference in yields between the 10-year Treasury and the 3-month Treasury. Okay, that summarizes the slope of the yield curve. Yeah?
Why the 3-month versus the 10-2?
10-2 is another one that you'll see people use. The 10-30 has been the one mostly used for what I'm going to talk about now. It's been the more reliable predictor of recessions. Okay? Good question, though, because the 10-2 is one that we were seeing a lot. That one inverted even before this one did. And it was pitched as a predictor of recessions at that time. So you can see every time the yield curve inverts, okay, the 10-year yield goes lower than the 30-day yield, a recession follows. Okay? Over and over and over again, and we've inverted again. Okay, there's our most recent inversion right there. So, if history repeats itself, there's a recession coming. Okay? I am going to say right now, I'm not going there. It doesn't have to happen yes, it's happened historically one time after another, right? In order to understand whether it's going to happen now, we need a theory, right? You need an economic theory as to why this happened, right? And then we got to see whether that theory is actually applicable to the situation going on today. There are other reasons why the yield curve may have inverted more easily now than it has in the past. And they have a lot to do with monetary policy and quantitative easing. The driving down of long-term yields through was the goal of quantitative easing. Okay, and so that was going to flatten the yield curve by definition. Does that mean we have to have a recession? Well, stay tuned. We'll see. But it's not good news, obviously, but it doesn't. I'm not going to say it's 100% guarantor of a recession. So we can move on from there. Okay, so short-term prospects I'll close with. I don't have a whole lot. It's just one slide from here. Okay, and this is essentially what I started out with. If you think things are bad here based on what I just showed you, and they're not that bad, right? I'm just showing, emphasizing the negative here. Let's face it. Okay, it's worse everywhere else. Okay, the rest of the world is much more uncertain. They're suffering more than we are, and they're searching for yield. They can't get any return at home, right? Nobody wants to buy German bunds. They're yielding minus 0.3%, right? You can't. You're losing money by saving, right? And so people are bringing their money here, and it's been going on forever, but it's especially picked up after the Great Recession. The search for yield, as a matter of fact, it's actually got there's a somewhat competing and somewhat complementary paradigm that's promoted by Ben Bernanke, the former chairman of the Fed, who's a colleague, of course, and has been forever, of Larry Summers. He talks about something called the global savings glut. All those funds out there in the economy that I was talking about before, right? He thinks that's the biggest problem of all. Larry Summers says that's just one of the problems, right? But Bernanke's all about the global savings glut. The whole world, all those funds, they need to park them somewhere safe where they can get a decent yield. They don't have to worry too much about risk. They don't have to worry about it being confiscated. They don't have to worry about governments changing that are going to confiscate their savings or regulatory issues. They can bring it to the United States, right? We are the source for investment globally. And it's been going on since the 1970s. That's where petrodollars came from, right? That the eurodollar market started because of OPEC and the fact that they needed somewhere to put their dollars that they were earning from oil. And they put them in eurodollar accounts. All that money essentially is feeding into the United States economy, okay? And it's been going on much more over the last decade than it has historically. That's somewhat good news for the United States economy. I mean, the rest of the world has confidence in us, right? And that means that they bring their funds here. That's keeping our interest rates low, right? As they bring their funds here, it's increasing the supply of funds in the economy, and that drives our yields down, okay? So part of our low yields may be a reflection of secular stagnation elsewhere in the world, not necessarily here. And that's a much more positive message for the United States economy than all this other stuff that I've just been putting in front of you. So that's about all I've got for, like I said, I don't like to do forecasts. You can challenge me if you like. and maybe I'll come up with something. I don't know what else you might be interested in talking about, but I can probably answer some other questions about other things as well. Yeah, go ahead. Well, that's the uncertainty part. Nobody knows where that's going right now, and we keep getting fits and starts. Now the EU has started playing nice with the Trump administration, so we might get some sort of action on a trade agreement with the EU, but that's going to be horribly contentious. I can guarantee that that's going to be a tough one to get through. Plus, we've got now the UK that's going to have to sign a trade agreement with the European Union and with other countries if they're going to maintain their position in the global economy. The Chinese economy is suffering. Uncertainty has been magnified there from this virus that's now affecting, and it's starting to affect our markets now. Europe is in trouble. China is not growing at the rate that it has been historically, and looks like things may even get even worse. India is not performing at the level it has historically. All of these are reasons why, relatively speaking, we're doing a lot better than they are. And I got to admit, I forgot the question. So, what was I answering? Oh, the trade war. Yeah. So I mean, it's all that. So it's just adding more to the uncertain outcome. Okay? Yeah, go ahead.
Yes. From what country is the most money coming in from that parks their money in America?
Well, a lot of it's going to be coming from those surplus countries that I put up in there. Germany's going to be part of it. I mean, we can't get everything we need in order to understand all of those flows, I don't think. But certainly with respect to government, U.S. government bonds, we know who owns those around the world, where they're located. But that's just a fraction of the total foreign investment in the United States, of course. So it's going to be from pretty much everywhere around the world where people have accumulated funds and they want to put it somewhere safe and reliable. And that's pretty much global with people that have those types of resources. But I can't give you a better answer than that.
How much of that's in the stock market and how much of that's in the
Some of it's in the stock. I mean, we have a safer stock market than the rest of the world too. And you can, I read an article the other day that said, forget about bonds, just get your yield from the S&P 500, which is extremely bad advice. But I know what they're talking about, right? They're saying, why not, right? I mean, the bond market's going to get you a terrible yield. The S&P doesn't seem to be fluctuating that much, so it's acting like a bond. But some of it's in the stock market, there's no doubt. There's a lot of, I know that foreigners have invested heavily in the technology sector in the United States. But for the most part, the stuff that we're worried about is in the safer stuff. And that's what generated, I mean, a lot of what we're talking about is the same stuff that generated lots of the aspects of the financial crisis. The search for yield is what led to the creation of the mortgage-backed securities, the CDOs, and all of those types of things. Somebody?
Yeah, can you give me some hope with the European experiment when you see the Bund and you see the Germans? There was the philosophy, a job for life, and the French go through it too, and you see the French president pushing on the labor markets and trying to increase the retirement age. Mm-hmm. I mean, that whole experiment Europe-wide just seems to not be working. And I'm just not sure how there's hope, because if that continues for another 10, 15...
The UK doesn't have any of that, and their living standards are lower than they are in Germany. So I don't know. I don't know if I agree with that necessarily. I mean, they've chosen a different path. I understand that, and it may be difficult for them to finance that. But at the same time, the way they look at it is you're providing income that's supporting economy to people by structuring your economy that way. More guaranteed employment, more assistance when you get laid off, all of those types of things it's basically Keynesian economics. That's promoting spending in the economy too. So I have a tough time with sometimes taking sides in those types. I think the way we've done things is probably best for us, and the way they've done things is best for them. You're right to say that they're going to have funding issues, though. There's no doubt about that. But I'm hopeful, let's put it that way. The Germans have pulled through quite substantially. I mean, the reunification of East Germany was a massive endeavor and extremely expensive, and they did it. It hasn't been wildly successful, but they did it. Yeah, go ahead. Sorry, Carl.
Yeah, so one comment on a lot of the statistics that you're using. I think what you're not taking into account is a rapid change of technology. So if you really peel back all those stats, they tend to be just primarily, if the world was the same as it was years ago, here's how we'd measure it, right? But the world is not the same. If you really need to look at the technological advancements and how they're systemically changing every one of those statistics. And so, just to comment on that. But my main concern around that, or not necessarily around that, is really why is the Fed putting in billions of dollars of liquidity on an almost daily basis? That's my
Well, that's all
concern.
repo stuff right now. The repo market blew up on them, and the liquidity that they're providing to the markets now is to maintain the stability in that market, because that market is an important source of, well, it's the primary source of short-term funding for financial institutions and other corporations out there. And the repo market started to have a lot of difficulty because of the change. This gets complicated, but a lot of the change in the financial structure resulting from the financial crisis has led banks and financial institutions to behave differently than they did before. They were accessing the repo market aggressively, and then the lenders stopped lending into it at certain periods of times because they needed to have that capital on their books at regulatory periods. And so the repo rate would just spike, and then the federal funds rate was going with it, and that's a horrible thing for the Fed to have to do. So they're adding liquidity to the repo market. Essentially, they're providing they are offering the repos the lending that the financial institutions have pulled back from themselves, and that's caused the balance sheet to grow from that additional liquidity. But that's the only, since they started the drawdown of quantitative easing, it's bumped back up again, you're right, but it's because of that. And right now they've committed to keeping that in indefinitely. John Williams at the New York Fed, who runs that program, said, we don't know when it's going to stop. We don't know when we're not going to need it anymore, but I don't think they have any intention of letting that go indefinitely.
So that does not concern you? The amount
No,
of
okay. What concerns me is that we're in uncharted territory with monetary policy, much more broadly speaking. We have the way that the Fed, and again, this gets technical, the way that the Fed conducted monetary policy before the financial crisis is very different from the way they're doing it after the financial crisis. We all assumed that after the crisis that they were going to revert back to the original way, which has worked very well for an awful long period of time. And they've kind of backed off on that now and said, we think that this new way of doing things may have some advantages over the way we were doing it before. I don't see those. I don't know what they're talking about. And they're not hitting targets. When the Fed funds rate spikes because the repo rate spikes, that's a failure of Fed policy right there. And that's a reflection of the way they're doing things now, post-quantitative easing. The balance sheet is still at $4 trillion. And it's got to get down to about 1.5 or 2 to get us back to normality. And they're not going to get anywhere near that, I don't think. So I apologize for answering it that way, because this is pretty technical stuff. But operating procedures of the Fed have changed, and they haven't sold the public on why that's necessary yet, and it's continuing to cause problems that you're pointing out. So that's what worries me, is that they're going to lose control of monetary policy. Yeah.
A couple other questions for you. You talked about the long-term, the 10-year projected inflation rate of less than 2%. Mm-hmm. Can you give some color on upcoming entitlements, on how that may impact the economy, or expanding entitlements, U.S. entitlements?
I'm not familiar with any that are expanding.
Social Security.
Expanding?
Well, those that are going to be claiming anyway, right, from a
I
demographics
see what
problem.
you mean. Okay, so sure, yeah, I mean, it's going to become a bigger and bigger burden, there's no doubt. The aging of the population increases mandatory government spending, right? The things that you can't change because they're set by law. Social Security Act, Medicare, Medicaid, those types of things. Entitlement programs, yes, because of the aging of the population, those are going to grow. That's happening all over the world, right? And I don't know what we do about it except live with it. I certainly don't. If we know anything about the history of Social Security, it basically wiped out old age poverty in this country. We had a severe problem with people during the Great Depression. Old people were dying in their homes, right? And Social Security was meant to be a remedy for that, and it was wildly successful in solving that problem. I hesitate to backtrack on that. I really do. But certainly funding is going to be an issue. There's no doubt. And You know, we had a similar issue in the late 80s, right? We were running up against a Social Security funding crisis then as well. They put together a commission to solve it. It was called the Greenspan Commission because it was chaired by Alan Greenspan. And all they did was raise the tax rate a little bit, paid by individuals and by companies, and nobody even noticed, right? Try that now, right? We've become so polarized, and even a small increase, right? Another way to do it is increase, I mean, in order to pass the Social Security Act, they had to have an income limit. So, you know, I'm sure you know, when your income goes above about $120,000, you don't pay any more Social Security tax on that additional amount, right? And if they were to increase that limit, the funding problems would certainly be cut back. I know from the tone of your question, this is not what you want to hear, okay? but I honestly think that's the solution. I think social safety nets are important, and I think both from a moral standpoint and from an economic standpoint, because those are people that contribute to the economy because you've given them money, and they will spend it.
Perfect. And a hypothetical personal question. So if you're nearing retirement, what is your expected return on the market over the next 10 years?
Yeah, that's a good question, and I myself am figuring very pessimistically, and I'm looking at, like, you know, averages as low as like 3-4%, just to be safe. I think that's more pessimistic than I need to be, but that's what I'm essentially gauging my own retirement portfolio on. I think, I hope it's not lower than that, you know, but that's the approach that I'm taking, because, like I said, I want to err on the side of caution, and so I believe it'll probably be a little bit higher than that, but not much at all. I don't think. I mean, you're familiar with all the news that's coming out. Corporate profits, we know, are coming down, right? Which is why when you survey corporate CEOs, they all say, yeah, I think we're going into a recession, because they see their sales dropping, right, on their own books, and they figure that it's an economy-wide phenomenon. I don't know if that's true at all, and it may not be, right? But it's, you know, the more pessimism we generate, and we've generated quite a bit, the more likely it is to be a self-fulfilling prophecy too. People start to expect bad times. They start to act in ways that bring those bad times about. Okay? I think bad times are coming in the future. I stop spending. I save. Right? That makes the decline in spending is what brings the recession on right there. Yeah, go ahead.
So backing up from monetary policy, we say it's reaching the limits. Don't we go back to look at the failure of fiscal policy and social policy? We need more workers, right? I mean,
Yeah.
that would address a lot of
Yeah.
this, more workers in the economy.
Yeah.
Productivity is a tricky thing. And you know, you've read all these theories about maybe, you know, that comes from big innovations, big advances. Where are those? We can't depend on those. But just a greater workforce participation, whether it come from internal and social policy to address some of those issues, or greater immigration, would actually address a lot of that.
That's right.
But there's that failure now to look seriously anymore, I think, at, like we have in the past maybe, around fiscal policy and also social policy.
That's right. I agree. And if you think it's bad here, I mean, the immigration policies in the rest of the world are even way more restrictive, right? We still allow some immigration, right? Which has been pretty much I mean, most economists are agree that that's been beneficial for our economy. And you're right. One way to grow your labor force, which keeps your economy growing, is to allow for more immigration. It just then it becomes competition across countries then, right? And people start to vote with their feet. If we provide them with the opportunity here, then they're going to come here. That's right. Go ahead.
A couple of times, and you actually just mentioned it again, you stress the importance of continuing to spend to avoid a deflationary situation. And at that point, for monetary policy or the Fed or the government to step in to spur that spending, I'm curious, the Federal Reserve kept interest rates at zero or historic lows for such a long period of time, and now we're kind of at historic debt levels with the government, but also consumer and corporate debt. Do you have any concerns with that debt level?
Yes, absolutely. I mean, any economist that says that they're not concerned with debt is, well, they're part of a new school of thought called modern monetary theory then, I suppose. But there is a branch, there is a place for those people now. But yeah, we're all worried about debt. And I'll tell you a little story about why I'm less worried about debt than I used to be. And I'm not alone. It's just pretty much been a change in our attitudes in the economics profession, broadly speaking, about this. Because we've always been concerned, and this is kind of a long story, so I'll do it quickly. We've always been concerned with trying to figure out what is the limit to how much debt we can take on. Well, the way we measured government debt burdens is debt as a fraction of GDP. And you know, the United States was roughly about 40% for years and years and years. But we were always interested, and economists always been interested, how high can it go as a fraction of GDP before it starts having negative impacts on your economy, right? And that's not an easy thing to measure. So some very well-known economists, Ken Rogoff from Harvard, who was probably going to win the Nobel Prize one day, and Carmen Reinhart from Johns Hopkins University, they wrote a famous book that, I mean, it was a New York Times bestseller called This Time It's Different. And that book was essentially a compendium of their research where they had gone out and collected more data on what are called sovereign debt crises. Think of them as financial crises, because back in medieval and Renaissance times, the only financial crises that occurred were sovereign debt crises. Okay, so they create government debt crises are the same thing. So they collected a whole bunch of data of all these episodes all over the world and on the economies as well, right? And this is a massive data set, historical, going back in time, and they pieced it all together. And they did some economic analysis, ran their regressions, and this wasn't in the book, but it was in one of their academic papers. They purported to come up with a result that said, okay, we've got it now. Your debt to GDP ratio goes to 90%, then there's a statistically measurable decline in your growth rate after that. And this is one of the few times an academic paper hadn't even been published yet, was influencing policy. It was being used in the discussions with the Southern European countries with what they called the triumvirate. The European Central Bank, the IMF, and the European Council were the three organizations that came in to bail out Portugal and Greece, and et cetera, mostly Greece. Okay, and they basically said, okay, we've got this now. We know what the limit is, and we're going to use that to try to force these debt to GDP ratios down. Okay, and that's informed. The policy was set up. The austerity plans that were imposed on Greece in particular said you gotta cut your government budget deficit. So right in the middle of the worst recession the Greek economy has suffered in years, they're being told to increase taxes and cut government spending. What do you think happened to their debt to GDP ratio? It went up because GDP went down so far. Right? People forget there's a denominator, right? Debt over GDP. If GDP falls more than debt falls, then the ratio goes up. And that's exactly what happened. They killed the economies even more. So a kid from Austin, actually, was a Ph.D. student at the time at the University of Massachusetts at Amherst. And he wanted to get into their data and check it out himself. And so he wrote the authors and he said, I want your data. I want to look at this independently. You know, there's a tradition in academics, you're supposed to do that, right? Now, this was a big, massive proprietary data set that probably a team of PhD students and undergrads had put together over years. And so obviously they're going to be a little bit hesitant to just start passing that out to people, but eventually they had to, and they gave it to this student. And he got into their data, started piecing it all together, and found out that there's all these fudging going on. They're eliminating cases that don't match their argument. They are not taking time periods for certain places that don't match their argument. Of course, they claimed ignorance and said, oh, it was their grad students and their research assistants or whatever. He pieces all that stuff together and the result goes away. There is no statistically discernible decline in growth at any debt level. Do you know what the debt to GDP level is for Japan? About 275%. Okay, now Japan has had some economic issues, but their financial markets have performed very well, right? They're a very high income, high living standards country, but they've decided this is how we're going to go about doing this, right? And they did it differently than anybody else. They're going to have to pay it back. It's going to be a huge burden, don't get me wrong. But it hasn't killed their economy in any stretch of it. Their economy was dead. That's why they had to do it to begin with. So I'm not here to advocate unlimited accumulation of debt. Okay, that's certainly not any economist that you're going to find that's going to do that. But we think because of the nature of countries versus people and governments and the difference in the way we operate, your spending is my income. Right? Households don't work that way. Households also can't print money. Okay? All of those differences together mean that the debt burden for a government can go higher than it can for the private sector. And I'm supposed to be done now. So, and I'm sure you guys are ready anyway. Yeah. So anyway, I thank you very much for having me. I know I tend to stir things up a little bit when I come do these things. I hope that's okay. If you want to talk about any of this stuff afterwards, I'm going to stick around for a while. And I appreciate you very much having me here. Okay? Thank you, Larry.